Yeah, so I'm going to talk about the Temple Bar Investment Trust today. It's a roughly 100-year-old investment trust. It's been managed by myself and my partner Nick Purvis since 2020. The two of us have been running money for about 35 years. We've been working together since 2007. We're probably best known for our value style of investing. There aren't too many of us left around today after value went through a torrid time. But actually, Temple Bar appointed us at a very good time. They appointed us in 2020 when value really started to turn. So I'm going to talk today really about I suppose value investing per se, how we apply that to the trust and the opportunities as we see them today. So I'm going to start by I suppose just reiterating this point that pretty much any empirical study that I've ever looked at tells you tends to identify three factors that work in investing in the long run. One of them is momentum, actually works. The other one is size. Size works in the long run, and the other one, of course, is value. All the research tells us that value works in the long run. Interestingly, the research also tells us that growth doesn't work and quality does not work. And I know that will surprise some people because quality and growth have, inverted commas, worked recently. But it shouldn't surprise you because it would be a really odd world, wouldn't it, in which you got to buy stocks that everybody else liked, stocks that had a higher growth rate or were below average risk, and you got paid a premium in the stock market to do that. It would be a much more logical world that if you were paid a premium to buy stocks that other people didn't like, and that's kind of why we think the value premium exists. Again, it's worth pointing out that if we break down the returns of value and growth by decade, over the last 110 years, value has beaten growth in all decades bar two, and the two where growth did better were the 1920s and the 2010s. And, I know a lot of you will be able to recognize the sort of similarities between those two decades in terms of, low interest rates and sort of roaring markets, valuations becoming irrelevant. But the point here is in the long run, value does better in nearly every decade except for those two. And I think it's worth pointing out that value, it doesn't just do better theoretically, it does better at least as applied by us in practice. So these are the returns of the Temple Bar Investment Trust over various periods of time. You can see that year to date, we've had a very, very strong year. So 12 versus 6 there for the market. And since inception, 92% versus 47 for the market. So we've nearly doubled the returns of the market. So there's value working in practice, not just in theory. And if you want to, take a longer and more statistically significant look at, I suppose, our outperformance, this is the performance of our longest running client. We've run this fund. It's called the St James's Place Equity Income Fund for over 20 years now. This is an unbroken 22-year track record, and you can see again, the returns of over 400%, over double the returns of the market throughout that period. Important to point out, though, that we don't outperform every year. Value goes in and out of favour, and obviously throughout that period, there have been periods in which what we do has not been in favour and has not done well. But the point here is to look across the whole period and to recognise that we have produced very significant outperformance for our investors over that period of time. I think this is probably a chart worth bearing in mind the next time someone's pitching you passive investing and telling you that no active managers can outperform. So let's just turn now to why does value investing work? And very simplistically, we think it's because investors have a tendency towards extrapolation and biases, I guess. And if what we're looking at here is a chart, it's a study that was done, it's called the level and persistence of growth rates. What the study did was looked at the US stock market. And what it's doing is it's dividing the stock market into companies, into 10 deciles, by their growth rate in the last 10 years. So the stocks over on the right-hand side were the companies in the market which had grown at the fastest rate in the last 10 years. And the stocks on the left-hand side, those that are growing at the lowest rate. And what we're actually looking at is the valuation of those stocks. So the stocks on the right-hand side that are growing the fastest had the highest valuations at the end of that period. And that kind of demonstrates my point about the fact that investors have a tendency to extrapolate forward, because people are putting those stocks on high valuations because they're assuming those high growth rates will persist in the future. So is that assumption correct? No, it's not. As you all see on this slide here, this is an actually updated version of the same study. And what it does is it looks at basically stocks in the US market, and it looks at how, it basically says how many stocks grow above and below average, and how many stocks can do that on a cumulative basis. So if you just start off by looking at the bottom row, chance obviously would tell you that in year one, 50-50, 50 stocks above 50% of the market above average, 50% of the market below average, and then you go 25, 12 and a half, etc., etc. If you now go up and look at the actual data, it's extraordinary how close the actual data is to chance. In other words, what that's telling you is that there are very, very few stocks that actually can grow their revenues or their earnings consecutively over long periods of time. So investors extrapolating growth rates forward is basically wrong on average if you look at that data. And so what does that cause in the stock market, and what's the relevance for that for value investors? It basically means that share prices move around by more than is warranted by the changes in the underlying intrinsic value. And we've put here, I suppose, the emotions that drive those moves in share prices. When things are good, people sort of tend to have that euphoric period, don't they, when they can't see anything going wrong and they pay very, very high valuations for companies. And then they do the opposite at the bottom. When things are bad, they become very, very gloomy and they can't see how anything is ever going to get any better, and they pay very, very low valuations. And simply, if you're a long-term value investor, that presents an opportunity for you, because what you're doing is effectively you're exploiting the overreaction in other investors, and you're buying stocks at below their intrinsic value, the fact that the share price has been put below its intrinsic value by that overreaction and extrapolation. And there are lots of different reasons why people are prone to overreaction and extrapolation. The one over on the left-hand side is the economic cycle, and I'm going to come back to that in a minute because it's very, very, very important. But people overreact to, the capital cycle, the credit cycle. Obviously, financial crisis, great example of that. Sometimes strategic errors. Sometimes people will misdiagnose companies as structural decliners. So there are lots of reasons why investors overreact and I suppose give long-term contrarian investors the opportunity to buy cheap businesses. But let's come back to this, the one on the left-hand side here, the economic cycle. In the last 4 years, we've had two amazing episodes in which stock market investors per se became very, very gloomy about the economic cycle. The first one clearly was 2020. It was the pandemic. Pandemic obviously was a situation in which there was lots of uncertainty because it was a new thing for most investors. People didn't really know how long it would last, what the effects were going to be. But basically they reacted like they always did, which was they effectively priced in a recession, and they priced stocks as if that recession was never going to end. And then people did exactly the same thing last year. And of course, this was, partly as a function of the energy prices going up, cost of living crisis, interest rates going up, et cetera, et cetera. But we got the same effect, which is we got to the stage where, what this chart is showing you is what percentage of investors think there's going to be a recession. We get to the point where nearly 80 or 90% of people think there's going to be a recession. At that point of time, you've got to remind yourself that that is probably consensus, and therefore it is probably in the price. And that's really where we think we got to in both of those instances. we got to the stage where people had more than factored in a recession into share prices. And actually, at the end of the day, believe it or not, recessions, so long as they're not permanent, and most recessions aren't permanent, don't cause a permanent change in the intrinsic value of a business. And what we've done here is we've looked at all the major macro events over the last 20 years or so. And the chart is showing you the spread in valuation between defensive stocks and cyclical stocks. So when that line is moving down, that is cyclical stocks becoming cheaper. And you can see, where we got to last year. You can see where we got to in 2020. Compare that to where we got to in the Great Financial Crisis and where we got to, after 9/11, et cetera, et cetera. So on each of these occasions, investors react in quite a predictable way. They become very fearful. They just want to sell cyclical stocks at pretty much any valuation, and they want to buy defensive stocks at pretty much any valuation. If you can basically go in the opposite direction, that presents a really positive opportunity for you as a contrarian value investor. Okay, what I'm going to do now is I'm going to go on and give you a few examples of stocks in the portfolio which have rallied very significantly since last year. I mentioned earlier on, we've had a very good few months with the Temple Bar Investment Trust. And of course, part of that is lots of those cyclical companies rebounding very, very strongly. If you look at, some of the big movers year to date, we've seen things like EasyJet up 60%, Currys up 50%. So very big moves of oversold positions in cyclical stocks. But let me talk specifically now about a few companies in the portfolio, and I'm going to start with Marks and Spencer's. Marks and Spencer's, we think, is a company where there's significant change going on. And I don't think investors really have realised how significant the change going on is. I think people still tend to focus on the clothing and home business, and they probably walk into their local Marks and Spencer's and think this is pretty drab and dreary, and therefore they sort of miss the huge changes that have been going on at the company. They started about 5 years ago when a chap called Archie Norman became the chairman of the company. He basically recognised the problem, which was that they had a big store portfolio, 300 plus stores, of which about 80 made all the profits. A great big long chain of unprofitable stores, and they basically had no online presence. So he set about changing the business. He's shut down a lot of the unprofitable stores. He's relocated some of them to out of towns where they're significantly more profitable. And he's grown the online part of the business very, very dramatically. I mean, to the point where, believe it or not, Marks and Spencer's is now the number 2 online clothing retailer in the UK, second only to Next Directory. So that business has been fundamentally transformed. And then if you think of the other parts of Marks and Spencer's, obviously it's the food retail business. And again, that was always a pretty good business. And I think it's just become even stronger over the last few years, particularly with the deal with Ocado, which meant that they could go, online and they could do home delivery. The management team have set out some targets for where they think profits can get to, and the targets are roughly 4% operating margin for the food retail business, 10% for the clothing business. If you kind of run those figures through, you get to about 27 pence of earnings per share. You put that on, 12, 13 times, you get to probably over £3. So we don't think that's a massive stretch. So an intrinsic value of about £3, share price today between 150, 160. So, there's a potential doubler. The amazing thing here, by the way, is in October of last year, the share price was below £1. So £3 intrinsic value below £1 in October, and today it's rallied to about 150. So that's the first example. Second example I'm going to take you through is ITV, which again, this was 50p at the bottom in October last year. It's rallied to about 90p today, so we're up over 60% since October. Similar sort of dynamic here in that we've got a company which is made up of 2 businesses, and I think investors have a tendency to focus on the bit that they don't like, which would be basically the just the TV business, and they don't tend to look really at the ITV Studios business. The ITV Studios business is, what, believe it or not, one of the biggest global creators of content in the world. 55% of their business comes from outside of the UK, so you can't even make the case that this is very geared to the UK economy. They have a target to grow their revenues 5% per annum, and to get margins up to around a sort of 13 to 15% range. That would drive operating profits of about 250 million. We would therefore say that that business on its own is worth 80p a share, just the studios business. And just to remind you, that was the whole group was 50p a share back in October. So another indication of how unbelievably pessimistic investors were. The media and entertainment business is basically the TV business. The big change going on there is in the past, people used to say that linear TV was dead. We're all going to move to streaming. Of course, lots of us have moved to streaming and watching Netflix, etc. ITV have launched ITVX, which is their own streaming business, which you can either watch for free with adverts, or you can pay a small amount to get the premium version and watch it without adverts. Very early signs, but very early so far. But the signs so far are very positive, actually, that is going to make a real impact, and the response from advertisers has been very positive. I'm going to move on to the third example, which is IDS. IDS is a business formerly known as Royal Mail, and I think you could probably call this a special situation. Again, similar sort of picture here, though, which is that it's a group made up of two businesses, and I think investors have a tendency to just focus in on the bad bit. So let's start with the good bit. The good bit is a European business called GLS, which is basically a parcels delivery business. The two charts there are GLS's revenues and GLS's operating profits and margins. You can see there, GLS is a pretty good business, pretty solid growth, nice margins. It's obviously benefiting from the growth in home shopping. We reckon that business itself will actually, it's made about 350 million this year. If you put that on a 12 times multiple, that would suggest that business on its own is probably worth £4 billion. Market cap of the whole Royal Mail group today, just over £2 billion. So investors are valuing the UK business at probably negative £2 billion. Now, the UK business is loss-making at the moment, and I guess lots of us will be aware about the sort of difficult industrial relations side going on there at the moment. However, just remind yourself, there is not just nothing in for that business, there's a negative in for that business. We believe that business, if ever it reached its potential, could be worth another £5 a share. And I'll just sort of throw into the mix, the UK business has got excess properties of about £1.50 a share. So you add all that lot up, and I know there are lots of ifs there, but you could get to sort of between £8 and £10 a share compared to £2.30 today. So, some obvious obstacles to overcome, but potentially very big upside. Final thing I'll add here is that this is more than a theoretical sum of the parts, because there's a family office called Vesa that own 25% of the business, and we own another 10% of the business. So between the two of us, we've got over 35% of this business, and therefore significant influence. This is just a breakdown of the portfolio by sector. You can see the big exposures to areas like energy and financials. This is the top 10. I guess I would just point you to a couple of facts there. Look how low the valuations are. So even after, obviously we've rallied quite significantly recently, but lots of PEs of sort of 6, 7, 8 times, lots of dividend yields of 4, 5%. So valuations still look very attractive to us. And I'm just going to finish with, I suppose, a couple of thoughts on markets and the opportunity set. And I'm going to start with the US stock market. This is simply a valuation measure of the US stock market. You'll notice that this goes back sort of, over 50 years. I updated this at the end of last year. And by the way, the US market's gone up since then, so the valuation will be higher today. But you can see that the valuation today is higher than it was in 2000. Some of you, I'm sure, will have read a note by a chap called Jeremy Grantham at GMO, who describe the US stock market as the sixth super bubble in financial market history. So the sixth time that any asset class has moved 3 standard deviations away from its long-term trend. So far, all the other 5 have collapsed with devastating consequences. So, personally, I think the US stock market is a very dangerous place to have your money today based on valuations. And let's contrast that with the UK stock market. UK stock market here, again, note 50-year chart. This is the valuation relative to MSCI World. We are trading today at the biggest, pretty much the biggest discount that we've been for 50 years. So about a 40% discount to MSCI World. What I find extraordinary about, I suppose, these 2 charts is that because investors have become so fixated on market cap weightings, lots of people will have 70% of their clients' equity exposure in the first chart, the US market, because it's 70% of MSCI World, and they'll have 5% in the second chart because the UK is 5% of MSCI World. To me, that's just bonkers, and in no way should you have 70% of the 6th Super Bowl in history, invested there. Within the UK market, value looks very, very cheap relative to growth. Again, note this is a 50-year chart, and we're trading at the sort of biggest stretch between value and growth that we've seen over that period of time. It's worth just pointing out that markets where currencies have depreciated tend to outperform following that period of depreciation. Of course, sterling has been very weak in recent years. And there are 2 reasons for this. One is the fact that the currency tends to mean revert. The second, more subtle one, is the fact that the companies within that country, of course, get an advantage of a cheap currency. And final slide, and then I'll pause and take questions, is that dividend yields used to be quite popular in this country. The income sector used to be one of the best-selling sectors in this country. And then we went through this period where investors just became used to the stock market going up 20% a year, and they thought, well, who needs dividend yield? I'll just sell some of my capital every year. I suspect those days are behind us. I don't see stock markets going up 20% per annum anymore. And if that's the case, then maybe dividend yield is going to become important once more. The UK is a great place to start because it has a dividend yield of 4%, which is the highest of any developed market. Our portfolio yields a little bit more than that. I am going to pause there. I hope that was enjoyable and informative for you all, and I'm happy to take any questions.
Excellent, Ian. Thank you very much. I think that was very informative and very well informed. So excellent use of data throughout. So yeah, we've had questions coming through. So first, to go to the nature of value investing, Stephen Darcy asks, when determining value, do you focus more on earnings or book value?
Yeah, no, we don't look at book value at all really these days. I think, but once upon a time, back in the sort of Ben Graham days, price to book used to be the thing to look at. What we focus on is what we describe as normalized cash earnings. So actually, Marks and Spencer's was a good example of this. What we'll do is we'll basically try to ask ourselves, where do we think this business can get to? Where can its earnings get to on a 5-year view? And we basically convert accounting earnings into cash earnings. So in the case of Marks and Spencer's, we come up with a figure of 27p of normalized cash earnings, and then we basically use that to assess the intrinsic value of the business. So you put that on kind of 12 times, you get to £3. So normalized cash earnings is how we think about value investing. But it's worth pointing out, all 3 of those examples that I went through, there was also I suppose you could think about it as a significant margin of safety, because in all cases you had the value of the group worth less than one part of the business.
Excellent, thank you. Now, yeah, we've certainly had questions about political risk elsewhere in the talk, but here's one coming through about the UK rather than Vietnam. How concerned is the trust about a potential Labour government and some of the changes that might come about should that happen?
Yeah, Not that concerned, to be honest. And I'll give you two reasons for that. From what I see, I just don't see that the policies are going to be that different between the Tories and Labour Party. They all seem to have shifted to the sort of left of centre, and I just don't see. You know, we've got a Tory party. Let's not forget they're about to put corporation tax up from 19 to 25%. That has the tax in the UK at the highest level for 75 years. So I almost don't think that the Labour Party could be any worse than that. But I suppose the second thing that I would say is that you've always got to think that that stream of negative news is being reflected in today's share prices. And I think part of the reason when I showed you that the UK is trading at the biggest discount for 50 years to MSCI World, undoubtedly part of that would be people worried about things like political risk. So, my answer is it's probably not as bad as people are going to expect, but it is probably factored in share prices anyway.
Excellent, thank you very much. Now, I think with value investing, and I'm sure you'll agree with this, one of the skills sometimes is knowing when to cut your losses or realise that something perhaps is not going, the momentum is not going to change. What sort of approach do you and your partner take when it comes, when you've picked up something that you think is cheap, but several years on, the market seems to be stubbornly resisting that?
This is a really difficult question, because of course when we buy a business, we will only buy a business where we think earnings are going to be significantly higher on a 5-year view. So, in other words, we're not what Warren Buffett, I think, once described as cigar butt investors, where you're buying something that's cheap and you're sort of getting the last puff of the cigar. In that case, we're trying to buy businesses where we think they are reasonably high quality businesses, and that the intrinsic value of that business will increase over time. Now, we are not always going to be right about that. There are going to be times when we think we're buying something which is in a cyclical downturn, and it turns out actually it was a structural downturn. So you go back about 10 years or so, we owned shares in Trinity Mirror, which was the regional newspaper business, and we our thesis was that they could migrate from a print to a digital world, without the profitability of the business being impaired, and that was wrong. It was wrong. That was business in structural decline, and eventually we sort of had to put our hands up and say, this is a wrong, and we sold it. We sold it at a small loss. I have to say, don't do that too often, actually, but we will do it occasionally. Actually, sorry, can I just add one final part, which is that value investors get asked about value traps all the time. There was an interesting piece of research came out from a US company called GMA last year, which actually showed that there are more growth traps than value traps. That, in other words, growth companies that disappoint, and when they do disappoint, they fall further, because the expectations are so high that when they disappoint, you tend to get a big reset. So I always feel slightly maligned. I spend my life talking about value traps, and yet the managers around at Baillie Gifford never had to spend their life talking about growth traps.
Well, I'll make sure that next time we have a growth-focused fund manager, we do put that question to them. Then there's so talking here about macro views and sentiment of the UK. Martin McGrath says there's an awful lot of negative sentiment recently. He's flagged up comments from LNG's chairman this morning, the ARM decision investing in the US. I think we had AstraZeneca 2 weeks ago. How do you think the market, the UK in general at the moment? Is that pessimism feeding valuations?
Yes, I think it is. Funnily enough, I was at a lunch today. It was organised. I won't say the name of the company, but they basically got a room full of sort of senior fund managers, and they're a sort of corporate advisor who are well linked into lots of the FTSE 100 companies, and their perception was that this whole idea about that everyone's about to up sticks and relocate to the US is just completely being blown out of proportion by the press. I know everyone can quote sort of CRH or ARM or whoever it is, but none of their clients are even thinking about this. So I think that is a bit of a storm in a teacup. I'm aware of the fact that I've stopped watching BBC. I've stopped listening to the Today programme because it is just unremitting gloom and doom. But I've just come back to my original point. I think therefore that is probably in the price, that gloom and doom explains why some of lots of these businesses are so lowly valued. And I'll just reiterate the point that over time, if you consistently buy undervalued businesses, you will get excess returns above the market, and vice versa. If you pay up, you should expect to get lower returns in the market.
And I'm looking at the current composition of the trust. You seem to be quite weighted at the moment towards the FTSE 100. The big multinationals. I think with your two largest holdings are BP and Shell. So It does seem that the trust is kind of, it is adjusting to this sentiment. Do you think that's the balance that's going to hold over the next 3 years, or could you see yourself going back into more kind of consumer FTSE 250 companies in time?
Okay, let me literally give you 60 seconds on the energy thesis, because it's the biggest part of the portfolio. It has been the biggest part of the portfolio for about 3 or 4 years, and actually we are still very, very confident in it. The thesis in a nutshell is, for sort of political and environmental reasons, the country and the world have basically started to shut down the old energy system before the new energy system was in a place to be able to come on and replace it. And so let me give you an example. In 2013, the largest 40 oil companies in the world used to spend $600 billion a year in finding new oil. Today they spend $200 billion a year in finding new oil. You can't just reduce your exploration budget by that amount and still expect to replace your production. And of course we haven't. So supply is running down, but demand isn't disappearing. Even before Ukraine, that was putting upward pressure on energy prices. And what would ordinarily happen is when the oil price went through, $90 or $100, everyone would start spending again, wouldn't they? All these budgets would start going up again, and eventually you'd get back to an oversupply situation. Well, again, because of political pressure, these budgets are not changing at all. This is why these companies are buying back their own stock, paying big dividends, because they are consistently being beaten up. I mean, sometimes, in the form of windfall taxes, and told not to invest. So they are, they're doing what the politicians are telling them to do, not investing. And therefore, I can't see energy prices coming down anytime soon. And yet that is not reflected in the valuations today. If you go back to that top 10, BP, Shell and Total all trading on price earnings ratios of about 5%, free cash flow yields of about 20%, dividend yields are sort of 5, 6, 7%. So we still think these stocks are very, very cheap, and we still think that the fundamentals for the industry are very, very strong.
Great, that's good to know. So a question's come through here about, and I suspect this is the type of thing you perhaps get asked by retail investors quite a lot. How does Temple Bar distinguish itself from other UK equity, either income or value trusts? They mentioned City of London, they mentioned Merchants. There are of course others. If you had to make a sort of elevator pitch to the typical retail investor as to why you should be the FTSE focused fund in their portfolio, what would it be?
More focused, so 20 stock portfolio. So we have big positions in stock that we have conviction in, and I would say that we are more value oriented than some of those companies. You would never see us owning what would be a good example, AstraZeneca, Diageo, Unilever, any of these sorts of companies at their current valuations. I'm not saying that we would never own them, and we have owned those stocks in the past. But today we think they are just way too expensive. So I think we have probably a stronger valuation discipline than those trusts. I think that would probably be the the main things.
So the focus. And I thought your comments about the we know that passive investing is very big at the moment. Your comments about kind of investors sort of being led into following the MSCI, which it sounds wonderful, it sounds balanced. When you look at it, it's what 60%, 70% North America. When you look at what that is, it's 50% or whatever, or 25% the big tech stocks. Yeah. You also said about the UK that it should be more than 4% of the portfolio. I know it's really difficult to put a sort of finger in the air numbers on these things, but how big a part of the average portfolio do you think UK equities should be?
That is a difficult one because it's down to the sort of individual circumstances, isn't it? And what the other investments are with it. I mean, most of my own personal portfolio is invested obviously in this trust and in our open-ended funds, and therefore I've got very, very high exposure to the UK. But it's a really hard one to answer. But 5% in a market that is the cheapest of developed markets and the cheapest it's been for 50 years feels way too low to me. 70% in a market that's 3 standard deviations away from its long-run trend feels way too much to me. So somewhere in the middle would seem to be a more sensible allocation. Mm-hmm. It's interesting. We had a conference last year, and somebody at the end of one of my presentations came up to me and said, the UK stock market has a smaller market cap than Apple. Why do I even need to bother with it? And that kind of just told you all you needed to know about the sort of, I suppose, the mindset of a lot of wealth managers these days. They start with the benchmark as their frame of reference, and then they basically allocate money around that. So because the UK is small, they almost don't need to bother with it. So rather than thinking about valuation, I'm going to allocate here because it's cheap, they think I'm going to allocate here because it's big, which to me just seems completely the wrong way to invest.
Mm-hmm. And the change of sentiment. You spoke about the negativity that you might hear on certain broadcast shows, but then there are also lots of when we do get positive news, like I'm thinking, for example, when Goldman Sachs announced that it was kind of saying that actually I think we're underweight on the UK, we're encouraging our private banking clients to really get stuck into the UK. We hear those headlines tend to make a splash as well. Do you think there has been a switch in sentiment in the past year? How deep?
Yeah, there has. There have been 2 actually. So one is, you only have to go back, don't you, about 6 months, and the Bank of England was saying we were about to go into the longest and deepest recession for forever, blah blah blah, and of course we haven't gone into recession at all, and that's why a lot of these cyclical stocks have bounced so hard, because sentiment was so gloomy back then. It only needed to get slightly less gloomy for you to see a big increase. So that's point number 1. Point number 2 is, I think this is an interesting one, which is BP had their results about 3 weeks ago, and they actually announced that they were going to slightly pull back on the rate which they were cutting their carbon emissions, and they were going to start to slightly increase their investment into upstream oil and gas, because they think the returns there at the moment are very, very high. And the share price went up about 30% in 2 weeks. And a lot of that was attributed to US buying. I can't confirm that, but I'm told that a lot of that move was attributed to US buying. Certainly, I know that the CEO of the company did a roadshow around the US. And that is interesting, because I think if you're a US investor, you're probably looking at BP trading on a price-earnings ratio of 5 versus Exxon trading on a price-earnings ratio of 10. And you're thinking these are essentially the same companies, but one of them is on half the valuation of the other. And secondly, it's also starting to divert its cash flows into sort of high return upstream areas. And as I say, amazing how quickly that share price moved for what's a very large company.